Time to spotlight the current state of the market. What's next after hitting all-time highs? Joining us now is Larry McDonald, creator of the Bear Traps Report and New York Times best-selling author. Larry, it is so good to see you. I hope you had a wonderful holiday weekend. All right, I want to start out with one of the takeaways from your most recent newsletter. You say we've moved from peak Trump pessimism to extreme Trump optimism. So what does that signal now in terms of where the market is?
Well, it's, always be careful around month end, quarter end, where you got positioning and you come into the new quarter and people will kind of rebalance portfolios. That's what we're seeing. We run an institutional chat behind me with hedge funds, mutual funds, and pension funds on Bloomberg. And we're seeing kind of a rotation out of some of the things that worked in the first half, out of high beta things. In other words, high beta sectors move more than the market. And so right now, if you're at peak Trump optimism, you want to be taking down high beta names. In our trade alerts and the Bear Trap Report, we were big, aggressive buyers of high beta equities, Cameco, Freeport in early April in our trade alerts that go out via WhatsApp and on Bloomberg. Now we're taking down those high beta names as we've reached really peak Trump optimism. And at the end of the day, Diane, Trump views higher equities as dry powder to really force his agenda back into our trading partners.
Okay, and then so you've been vocal about market extremes. When you think about, a lot of our audience is retail investors, retail traders. What are consensus trades that you notice about retail investors that they should be cautious about, especially given the institutional knowledge that you have?
Well, one of the things I'm really proud of, and thanks to you, our book, How to Listen to Markets Speak, back up at number one in the recent days on Amazon and finance. And one of the things we talk about in the book is the bearish dollar thesis. And when you talk to global investors, this bearish dollar thesis has gotten very, very crowded. And what we're hearing in the chat is that Treasury issuance, because we've been at the debt ceiling for so long, and for almost 7 months now, we're at the debt ceiling. All that means for people watching us right now is something very important. There's been no new debt issuance. Now they passed the big, beautiful bill. And what that means for people, everyone should know that now they're going to ramp up Treasury issuance. And so we have to catch up. We calculate $1.7 trillion between now and December. It's $600 billion more than last year of Treasury issuance. And what that's going to do, it's going to drive up T-bill rates, 1-year T-bills, 2-year bonds, 2-year notes. And so the front end of the curve is going to suck dollars back, or suck cash back into dollars, and that's probably going to get you a counter trend rally in the dollar here. So if you have dollar trades on, or if you're exposed to commodities or some of these high beta commodity names, we expect a counter trend rally in the dollar over the next couple of months. So a lot of things that we're working in the first half, gold miners, uranium equities, copper, they could have a rough couple of weeks if we get a nice counter trend rally in the dollar.
Okay, all right. And let's talk about another thing that we're watching, earnings season coming up. Big banks obviously going to be in focus because they're early in the earnings season. When you think about all the noise around regulatory landscape, loan growth, et cetera, I know you talk about this in your Bear Traps report. What's the single biggest thing that you're going to be watching for in the earnings from the banks?
Well, think of Jamie Dimon. He's taken down his personal JPMorgan shares by 25% over the last year, and a lot this year. It's trading at 2.4 times book. A 5-year-old knows the bullish case for bank now in a Trump regime, with the chief regulator being a Trump appointee at the Fed. Literally a 2-year-old knows this. The spread between JP Morgan and the regional banks is the widest it's ever been. Again, 2.4 times book. JP Morgan has never traded there, and their CFO, their CEO, is dumping shares at the fastest pace he's ever dumped them, right? So you have to be selling your big banks here. buying some of the smaller ones. And as you come into earnings, the bar is very, very high for these banks.
But the bar is high, but everyone always, points out, and we see time after time that, JPMorgan Chase has this fortress balance sheet. Do you think that there is something, under the hood coming up?
The biggest thing is just sentiment. And yeah, I think that are we at peak optimism right now for the economy? Yes, there's some softness ahead. We've been through this since 2022. We've had three different times where there was peak optimism on the economy, and then 6 months later we were down with kind of hard landing risk creeping back. Think of the banking crisis of 23 with higher rates. So there's a whole bunch of things that are happening. Look at the long end today. It's back up there 5% on 30s. That's not great for housing. And so, yeah, so do you want to be taking down exposure to the banks? Yeah, there's probably something out there in the next several months for sure.
And you are expecting a pullback in the semis and semiconductors. You're predicting a 20% pullback over the next few weeks. What's behind that view?
Well, just sentiment again. The SOX S is something we like which is triple lever. You got to be careful, and this is not for everyone, but for speculative investors that need a hedge here, the SOX S we think is going to have a nice 3-4 weeks. But you're up in some of the semiconductor names. We recommended Micron in trade alerts in April and May. Micron's up 110% in 64 trading days. And if you look back historically, these are very rare numbers. And then NVIDIA's coming out in August. And so you just have, like a lot of times with semis, they go up on euphoria and they sell off on impatience and on the news. And I just think sentiment's gone way, way too far on the semis right here.
And Larry, quick final thought. I know you're bullish on coal and lithium. You see those as bullish themes. So for retail investors, can you tell us why you're constructive on those sectors?
Okay, so with coal, you had the Trump optimism on the election was very powerful. It sucked a lot of retail investors in. The coal names have been hammered for a whole bunch of macro reasons we can get into around the end of the Ukraine war, some issues with Asian demand. But the capitulation score that we've been getting on CNR equity or the coal ETF just is really pretty powerful. And you're getting a bullish MACD on the weekly, so you're seeing seller exhaustion there. Valuation, you're trading at 3 times EBITDA for CNR equity, core natural resources. We love the coal space down here. Value, and by the way, the Trump trade with the new piece of legislation here, the big beautiful bill, has huge positive carve-outs for the coal sector.
Okay, all right. That's Larry McDonald, creator of the Bear Traps Report and New York Times best-selling author. Thank you, Larry. Appreciate you joining us today.